In this video, the fast money traders highlight the current market conditions characterized by high volatility and low investor sentiment. They observe notable fluctuations in the NASDAQ and other indices testing their 200-day moving average, rising concern of further declines. Consequently, the traders advocate for a careful and vigilant approach before making substantial market moves, given the historical shifts between the highs and the lows.
That technically, I'm sure Steve's got a view, I bet Bono has a view. You know, there's a dynamic in terms of where we are relative to the 200-day moving average, so longer-term support, where we've been dancing really at support or below it. So the NASDAQ today finished really kind of back up near the 200-day, but if you think about where it was intraday, and it really looked like we were going to close at fresh new lows, you haven't seen the NASDAQ as an index move to the downside through the 200-day really since March of 2023. So it was an extraordinary week. And you noted Powell. He was really the white knight today because on a payroll number that was somewhat mixed, I would say at best, but it wasn't a disaster. So therefore, it could have been worse. You had Scott Bessent, the Treasury Secretary, who was out there talking about a detox for, essentially the economy or the markets or people that are expecting the kind of fiscal full plate that we've gotten over the last 10 years. And I think that's fair. I think there are a lot of people that are ready to listen to that and acknowledge it. But the Fed chairman was really the big deal today.
Yeah, the economy is fine. We can afford to wait. We'll see how policies net out. All good things that markets wanted to hear.
I think, yeah, especially given the context. So leading up to that, you had seen early parts of the day being much more positive and then rolling over into the later hour trading session. So I think, that reversal today was relatively positive. To Tim's point, though, I still think testing that 200-day moving average across the major indices is a bit concerning, and you want to see a floor kind of put in before jumping in with both feet. To the Bessent comments, I think there's a lot of logic there. Essentially, we have had this fiscal stimulus. You're starting to see some of that now in Germany that has fueled this market. That, along with interest rates for the better part of, a decade and a half. And so kind of moving from fiscal stimulus to corporate spending with the tariff overhang, which makes capital budgeting a bit more difficult in that context, I think is why you're starting to see things roll over. The last thing is that we simply were just kind of priced to perfection in terms of multiples, 22, 23 times. And now, you're starting to see what we thought was going to be strength within some of the smaller caps. That really hasn't held up because those are supposed to be somewhat insulated from tariffs. I think that uncertainty still continues to loom as a macro overhang.
When Tim talked about the S&P and technical levels, when you go back, he mentioned March of 2023. If you go back to October of 2023, that's where we fell off a cliff. And we were down below the 200-day moving average for about 6 days. Then we rallied pretty much to where we're at, to all-time highs. It had the same setup. And what created the rally? Powell. Powell creates this rally. Now, I don't know if it's going to be that type of a rally that we saw from October of 2023. There's a lot of things that have changed. But you do, I don't want to say you have a Powell put, but maybe you do have a softer stance. They're up to 3 cuts this year. Maybe we do get 4. But the fact is they're cutting. They're not raising. Right. So you have a softer stance by the Fed. You have tariffs. The key letters in tariffs are the ifs. We don't know if and when they're going to happen.
Hold on. Do that again. That was nice.
Are you ready for it now?
Yes.
The key letters in tariffs are the ifs.